First of all, let me introduce or revise the concept of beta. Beta is a measure of systematic risk. It measures the risk of a company as compared to the market, right? And that is what we are going to consider. So we are going to discuss about this geared and ungeared beta, and let's have a look on the formula of geared beta. So this beta G means the geared beta. Beta G is the geared beta, which is equal to ungeared beta multiplied by 1 plus debt equity ratio in bracket 1 minus tax. We will derive this formula, don't worry about it. But first let's understand about the concept. Let's say this is a company. This particular thing is a company. Okay. And this company is entirely financed by equity. Only equity. There is no outsiders money included in that equity, in that company. So that company's risk will always be called as the beta of assets, beta of ungeared company, or beta of unlevered company. When you apply that means there is no debt in the company. Similarly, if you take the similar company, exact same company, but the financing in that company, or we have taken loan in that company, that means there is a debt in the company. So if there is a debt in the company along with the equity, that company's risk will be called as beta of equity, beta of geared, or beta levered. Beta geared, beta levered, mostly this. Okay, sir. In that case, this equity beta will be calculated separately. But in that case, the equity beta and the asset beta will be same. But in this case, the asset beta includes equity and debt both. So understand this logic, that in case of ungeared company, that means if there is no debt, the asset beta and the geared equity beta will be same. But in case of a geared company, asset beta will include equity and debt both. So we will have to multiply the beta of equity with the weight of that equity and debt beta with the weight of that debt. Okay, so it will look like this at that time. See, if you want to calculate the beta of the asset beta of a geared company, it will include equity beta into weight of equity, beta debt beta into weight of debt, simply. In this case, there was no need because the equity was the only thing. So equity beta became asset beta. But in this case, we will multiply it. It's as good as taking the weighted average of each beta. Okay, sir, right. Now, couple of things that I want to confirm once before starting the formula. Let's say, for example, this company is going into liquidation. Total equity raised by the company is 5 crore rupees, and this company is now going into liquidation, and only 2 crore rupees is left with the company as a cash. So what will happen? For every share, every 1 rupee of the equity, company will be able to pay only 40 paisa to all the shareholders, because 5 crore is the liability but 2 crore is the only cash left with the company. So this 2 crore will be divided in these 5 crores in the ratio of 0.40:1. So 40 paisa for every 1 rupee will be given to all the shareholders. But what will happen if this 5 crore rupees is structured in this manner? That means 3 crore rupees is of equity and 2 crore rupees is of debt. And now if the company is going into liquidation, and if the company only has 2 crores of the cash left with them, the liquidation procedure says that first you will discharge all the outsiders' money. And in that case, this 2 crore rupees of the cash left with us will be given or paid entirely to the debt holders, and equity holders will get nothing. What does that mean? It means that if you include the debt in the company, if you raise the funds through debt in the company, then your risk becomes higher, or your risk increases. The beta of such a company will be higher than beta of this company. Because in case of liquidation, equity holders will not get the priority. In this case, equity holders are getting at least something. Out of 1 rupee, they are getting 40 paisa. But in this case, in the same situation equity holders are getting nothing, because the rule says that you will have to first discharge the payment of outsiders. So all the 2 crore rupees will be paid to the debt holders. So when this is a situation, having a debt in the company can be very risky. So one thing is for sure, from this part till the end of the mergers chapter, you need to make sure that the unlevered beta of the company will always be lesser than the levered beta of the same company. So geared beta or levered beta will be higher than the unlevered beta. That is what you need to understand. Okay. Now, geared beta will be higher than the unlevered beta. The risk of the company having debt in capital will be more than the risk of the company having no debt in capital. Okay, now coming over to this part. Understand. We discussed that ungeared beta of the asset and beta of the equity will be same in such company. But in case of geared beta of the asset will be equity and weight of equity, beta of debt and weight of debt. So this will be a weighted average of equity and debt beta. And how to calculate the weight now? Weight is very simple, sir. Take the equity in the numerator and equity plus debt in the denominator along with the tax saving. So there is something in the debt that is beneficial to the company which is called as tax saving on interest. Okay. In this case, how to calculate the weight of the debt? Take the debt in the numerator and equity plus debt 1 minus tax in the denominator. So it is like if you have 2 crore rupees of the equity and 2 plus 3 crore rupees of the debt. So 2 by 5 will become your total weight of equity. In this case, it will be 3 by 5 will become the total weight of the debt. Okay, got it? So this is how you will calculate the weight. But what happens normally? You can clearly see that in case of a levered company, the risk of equity holders increases, but virtually debt holders had no risk because they knew that in case of liquidation we will be the first to make the payment. So debt beta virtually is considered as zero. And if we consider the debt beta as zero in this equation, if we assume the debt beta as zero in this equation, this entire part will become zero. And the only equation left will be the asset beta is equal to equity beta into equity divided by E plus D 1 minus tax. Okay, so let's continue with that. Asset beta is equal to equity beta into E divided by E plus D 1 minus tax. Cool. Now what you have to do is transfer this entire equation on the other side, left hand side. So since this is multiplied here, it will come to the denominator of beta of the asset. So it will be like equity beta is equal to asset beta divided by equity plus debt 1 minus tax. Now you can take this as a separate part in this case here as asset beta into 1 divided by equity plus debt into 1 minus tax. When you reverse this equation, this denominator will become the numerator. So equity plus debt into 1 minus tax divided by equity. This is beta of the equity, right? Now this E is the common for this E and this debt as well. So we have divided it into both the parts. So when we separate this equation, E will become a part of this E as well and debt E will become a part of the debt as well. So we have divided equally to both. This happens. Like you can do it like this. I will just show you. Let's say 10 plus 5 divided by 3. 15 divided by 3, the answer should be 5, right? So you can do it 10 by 3 plus 5 by 3 and still the answer will be 5. So you can do it like this. And that's what we have done. We have allotted the equity value to both. So E by E will become 1 now. And this is debt equity 1 minus tax. Now the equation is like this. Beta of the equity is equal to beta of the asset in bracket 1 plus debt equity ratio in bracket 1 minus tax. Now you can clearly understand what this 1 means. It is nothing but E by E, and this is debt by E. E by E, debt by E into 1 minus tax. Now you can write down equity beta as a geared beta also, or levered beta also, and the asset beta as ungeared beta or unlevered beta. So this is the formula that you need to understand. It will take a lot of time, like a lot of practice to remember this formula, but it will be used in our calculation. Why we are going to use this formula? I will tell you. We are going to use this formula once to calculate, let's say, asset beta, and then again put that asset beta in the same equation with a different debt equity ratio to calculate the beta of the equity. You will understand it later on. This is the question in front of you. Let's read it. Question number 58. So this is the question on geared and ungeared beta as well. XYZ, a large business house, is planning to acquire ABC, another business entity in similar line of business. XYZ has expressed its interest in making a bid for ABC. This is target, this is acquirer. Now, XYZ expects that after acquisition, the annual earning of ABC, that means the company that we are going to buy, will increase by 10%. What will increase? The annual earning increase by 10%. Following information: ignoring any potential synergistic benefit, whatever the benefit will be there, that is 10%. This 10% increases the potential synergy benefit, right? Arising out of the possible acquisitions are, without considering the synergy benefit, the details are given to you. Please focus. Paid up capital in crore of XYZ and ABC. Who is XYZ? XYZ is the acquirer. Now try to understand. This is acquirer, this is target. Now, proxy entity for XYZ and ABC in the same line of business. This is the third company in the same line of business. Paid up capital is given. Okay. Face value of rupees 10 per share. Current share price is given. Debt equity ratio is given, and the equity beta is given. Okay, sir. Assume the beta of the debt to be 0. Corporate tax rate is 30%. Determine the beta of combined entity. Determine the beta of combined entity. How will you calculate the beta of combined entity? See, you have the paid up capital and the face value and the current share prices as well right now. What you can do is you can calculate the number of share with this. Then you, with the current share price, you can calculate the market value. Then you can total that market value as well. Just a second. Yeah, in this part only 10% of the earnings is given. So how will you calculate the combined beta? Combined beta means portfolio beta, right? Beta of the portfolio. And how do we calculate the beta of the portfolio? Let's go step by step. This is question number 58. Portfolio beta is equal to summation of weight I beta I. That means weight of ABC, beta of ABC plus weight of XYZ into beta of XYZ. First of all, let's focus simply on the weight of both the companies. How to calculate the weight, I will show you. You have the paid up capital divided by the face value. You will get the number of share, multiply it with the current share price. You will get the market value of each company. Let's try doing it. So the number of share will be 102.5 and 10.6. Okay, and once we multiply it, the market value is 13,284,583. and the total market value is, let me just check the market value, 13,867. 13,867 is the total market value, right? Now we can calculate the weight of, can we calculate the weight of each? Yes sir. 13,284 divided by 13,867, the weight will be 0.9580 minus 1, that's 0.0420. So these are the weights right now. Now understand, we will put the weights here, 0.9580 into beta plus 0.0420 into beta. So we have calculated the weight based on the market values. Clear with that? Now we want beta of both the companies, but the problem is beta of both the companies XYZ and ABC is not given. It is right here, equity beta. See, you will find no data for those beta is given. But there is one thing which is given in this question is 1.1. Can we take this equity beta in place of this? No sir. Why? Because the debt equity ratio of proxy entity does not matches with the XYZ and ABC. So what we have to do right now, see, we have to take the proxy beta, remove the debt equity of proxy from that, convert that beta to ungeared, and then this ungeared beta will be used for ABC and XYZ. So we will add the debt equity ratio of ABC, we will add the debt equity ratio of XYZ, and then we will have two different betas of ABC and XYZ. So this is what we are going to do, and this is what we have been doing since last two chapters as well in the international financial management, in the corporate valuation. We will take the equity beta of proxy, we will remove the debt equity ratio of proxy out of that, convert that equity beta into levered beta into unlevered beta or ungeared beta, and then after this ungeared beta, again we are going to convert that to geared beta by adding the debt equity of ABC and debt equity of XYZ. So the very first step, geared, this is for proxy, geared beta is equal to ungeared beta 1 plus debt equity ratio one minus tax, right? So what is the geared beta? 1.1. What is the tax rate? 30%. See, so we will find out the ungeared beta out of it. What is the debt equity ratio of the geared company? It's 1:4. We are going to remove this 1:4 impact from 1.1. So let's try 1/4 into 0.70 plus 1, 1.175. So the answer is ungeared beta is equal to 0.9362. This is the ungeared beta. So what we have done till now, we have converted 1.1 to 0.9362. Now this 0.9362 will be used two times, one with ABC, with the debt equity of ABC, and then we will calculate the beta of ABC. Have a look. And the other one with the XYZ. Now ABC, geared beta is equal to ungeared beta 1 plus debt equity 1 minus tax. So what is the debt equity of ABC? It's 1:2. So I will just write down this for ABC, 0.9362, 1 by 1:2 and 1 minus 0.30. This comes to 1.2639. This is what we are going to use. Then for XYZ, similar thing. Geared beta is equal to 0.9362 1 plus. What is the debt equity ratio in this XYZ and ABC? So I am writing it wrong. It should be XYZ and ABC. So 0.9362, this is 1:3. 1:3 is the debt equity ratio in ABC. 1/3 into 0.70 plus 1 into 0.9362. That comes to 1.1546. C. So that's 1.2639 and 1.1546. 9362, 1.2639. 1.2639 rounded off to 3 decimal, it will be 1.264, 1.264, 1.155, 1.155 rounded off. Now these two figures will be used in the main formula 1.2639. Let's have a look. 1.264 in this main formula of portfolio beta and 1.155. This will be 1.155. Let's do the multiplication. 1.211 plus 0.049. 1.26 is my answer. This is the portfolio beta of combined entity. Let's have a look. See, 1.26 is the answer. Institute has extended this by multiplying directly with the beta, or else you can use the simple formula of weight into beta as well. It will give you the same answer, 1.26. So don't worry about what the institute has done. Whenever you don't understand the procedure by institute now, you just do it by your original method. This is what you learned in the portfolio chapter. The portfolio beta is calculated like weight into beta, weight into beta. Calculate the weights, calculate the beta. The only thing that we had to do in this question is we had to take the proxy beta and remove the debt impact out of it. Use the ungeared beta twice for XYZ and ABC. We needed the geared beta for XYZ and ABC in the formula because we had the debt in the company. That's why we needed geared beta. So what we did ultimately is this: we converted this geared beta into ungeared beta and we used it twice for two different companies to calculate the two geared beta once again. That's it. So we removed the proxy's debt equity and we added the ABC and XYZ's debt equity in this. That's it. Simple question. Okay, sir. Let's move on to the next question now. That is question number 59. ABC, a large business house, is planning to sell its wholly owned subsidiary. Wholly owned, 100%. ABC wants to sell the subsidiary named as KLM. Another large business entity, XYZ, has expressed its interest in making a bid for KLM. So this is going to be acquirer, this is the seller. And this ABC is not selling its entire company, it's just selling one of the division, that is one of the subsidiary, KLM. Okay, XYZ is the buyer in this case. Its interest in making a bid for KLM. Now, XYZ expects that after acquisition, the annual earning of KLM will increase by 10%, as it was given in the previous question also, that after I acquire this company, the earnings of that subsidiary will grow by 10%. Following information, ignoring any potential synergistic benefits arising out of the possible acquisition, that means this increase in 10%. Ignoring this increase of 10%, the data is given. The profit after tax of KLM for the financial year which has just ended is estimated to be 10 crore rupees. KLM's after-tax profit has an increasing trend of 7% each year and the same is expected to continue. This will be your growth rate. Market rate of return is 10%, risk-free rate of return is 4%. That's it. 4 items are given in these 3 details. First of all, the profit after tax 10 crore, growth rate 7%, market return 10%, risk-free return 4% and the tax rate 30%. That's it, nothing else. Now, this is the table. Analyze the table for a moment. This is XYZ who wants to buy KLM, acquirer. This is seller who wants to sell its wholly owned subsidiary. Proxy entity for KLM in the same line of business. Now try to understand once. KLM has a category or is doing such a business which is not similar to XYZ or ABC, right? It is similar to this proxy entity, and the data of KLM is not given, the data of proxy entity is given. Cool, sir. Let's say we write down the KLM. Why this question will be difficult, a little difficult to you? Because we need the data to calculate the value of KLM, but the KLM's direct data is not given. Okay, instead a similar company is data is given. This company, the proxy entity, the dividend payout ratio of the proxy is 50%, debt to equity is 1:4, PE ratio is 12, and the equity beta is 1.1. Now, assume gearing level of KLM. Gearing means the debt equity ratio of KLM to be same as of ABC. What is the gearing level of ABC? 1:3. So it will be same as of KLM. Let me write down 1:3. Okay, sir. And the debt beta of 0. Now try to understand once again. We can use the data of proxy company, but the only difference in the proxy and KLM, both of them are in the same line of business. So maximum data will match and we can use the data of proxy for KLM. But the only difference is the debt equity ratio. The debt equity ratio of proxy entity is 1:4, whereas the KLM is 1:3. So at the time of using this equity beta, this is called as geared beta. Tell me, can we use this geared beta of 1.1? No, sir. We cannot use, because 1.1 consists of the debt equity risk of 1:4. That is of proxy. But we need an equity beta which includes the risk of 1:3. So what are we going to do? We are going to convert this geared beta into ungeared beta. That means we are going to remove 1:4 ratio out of it, and then we are going to add 1:3 ratio and convert it back to geared beta, which can be used for KLM. Okay, sir. This geared beta will be used in the capital asset pricing model with the market return of 10% and the risk-free return of 4% to calculate the cost of equity. Now, have a look on the question. Calculate the appropriate cost of equity for KLM based on the data available for proxy entity. So KLM's cost of equity can be calculated using CAPM, risk-free rate. The question is very easy. Understand, geared beta, market return minus risk-free return. So in this formula we have everything except for the geared beta. Now first question that you can ask is, why do we need geared beta for calculating cost of equity of KLM? Geared beta is required always if we have the debt in the company. If we have zero debt in the company, then we will use the ungeared beta or asset beta. Okay, so it's very much clear that we need geared beta. But this 1.1 of the geared beta cannot be used, because this 1.1 of the geared beta includes 1:4 debt ratio. So let's convert the geared beta to ungeared and then ungeared to geared back. Okay, so simple procedure I'm going to write down once again. It is given here, but just follow the process. What is the formula for geared beta? Always, I'm telling you, this is a suggestion, always start with a formula. Like whenever you are using the formula, don't just like remind yourself of the formula in your mind and then just write down the values directly. Like here, they have started directly with the answer. Never do that. Ungeared beta 1 plus debt equity 1 minus tax. So geared beta is 1.1. Ungeared beta we have to calculate. We have to remove 1:4 debt equity ratio, 1.30. So ungeared beta will be, let me calculate, (1.175) comes to 0.9362. So we have converted it from 1.1 to 0.9362. Now use it back to calculate the geared beta of KLM. Geared beta is equal to ungeared beta in bracket 1 plus debt equity 1 minus tax. Ungeared beta is 0.9362 in bracket 1 plus. What is the debt equity ratio of KLM? 1:3. Now can you see the difference here? I will just complete the answer and then we'll get back to you. it comes to 1.1546. See, we removed this part of 1:4 and added 1:3 in the beta. That's it. We wanted to remove someone else's debt equity risk and then add our debt equity risk. That's it. That's it. So the new beta that we can use is 1.1546. Now you can simply use the CAPM model, 10% and 4%, right? So 4% is the risk-free rate, 1.1546 is the beta, and market return is 10 minus 4. So the answer will be 10.93%. This is the cost of equity, 10.93%. That's it. The first answer is resolved. Now, a range of values of for KLM, both before and after any potential synergistic benefit to XYZ of the acquisition. Now, what the question is asking us to calculate is the value of KLM, first of all, and then the range. That means there will be two different bases that we have to use. Okay, so two values of KLM before synergy and two value after synergy. After synergy is very easy. You have to just add 10% to the annual earning. That's it. So let's first focus on the before synergy benefits. So we have to calculate values on the basis of two different basis. Like, let's find out the basis. What type of basis we can use to calculate? We can use the PE ratio model also to calculate the value. PE ratio multiplied by profit after taxes will give you the market value of KLM. Again, we can use the dividend growth model because we have the cost of equity, we have the growth rate here 7%, and we have the dividend payout ratio as well. So we can use that. So the two bases that can be used, one of the basis is current share price, but try to understand the share price of KLM is not given. The share price of KLM is not given. It's of XYZ and ABC. We don't want to calculate the value of XYZ and ABC. We want to calculate the value for KLM. And the KLM's one data which is given is the profit after tax. And profit after tax is used in the dividend also and this model also. PE ratio. There are two models that you can use in this question. So just have a look. Question number 59. Second part. Value of KLM on the basis of PE ratio. Let's start with easy part. What is the PE ratio? What is the PE ratio of KLM? Very easy, sir. There will be two different bases that you can use. You can use the data of proxy also. So at that time the PE ratio will be 12. But we can also argue on the fact that XYZ is buying that company. XYZ is buying that KLM, so XYZ will use its own PE ratio. So now there will be two different views for two different values. There will be in total 4 answers for pre-synergistic and 4 answers for post-synergistic. I will just show you. We will write down using XYZ using proxy. See, both of them are right. You can write down one only, you can write down both. So, market value, this will be pre-synergy. So, what is the formula for PE ratio? Market value is equal to PE ratio into profit after tax. What is the PE ratio of XYZ? It's 10. So we can easily say that 10 multiplied by 10, 100 will be the value of KLM. But if we use the proxy's PE, we can say 12 multiplied by 10, 120 will be the value of KLM. But this is before considering any synergy benefit. If you consider post synergy benefit, like if you consider synergy benefit of 10%, this value has to be increased by 10%. It will be 100 into 1.1, that's 110. 120 into 1.1, that's 132. That's it, simple. You can directly increase. You can increase the earnings as well, or you can increase the value directly, because everything will be multiplied at the end of the day. So these four are the values. Now understand, using XYZ data, the pre-synergy value is 100 and the post-synergy value is 110. Using proxy data, the pre and post synergy values are 120 and 32. This is just on the basis of PE ratio. Okay, another range that you can use is value of KLM on the basis of Gordon's growth model. Again, the same thing, using XYZ's data, using proxy data. Now, how to calculate Gordon's growth model? Market value according to Gordon's growth model is equal to earning. See, I will take down profit after taxes multiplied by dividend payout ratio. That means the dividend, right? Numerator should be dividend in bracket 1 plus growth divided by cost of equity minus growth. Am I right? Profit after tax multiplied by dividend payout ratio will give you the amount of dividend, which will then grow by 7% divided by cost of equity minus growth. So what is the dividend payout ratio of XYZ and proxy? You can see the XYZ is paying 40% and proxy is paying 50%. So if we follow the proxy company, we will pay the dividend of 50% of the total profits. But XYZ will argue that we are acquiring KLM and now we will be deciding that how much dividend we are going to pay. So according to our policy, 40% comes the dividend payout ratio. Now, pre-synergy value. Understand, what is profit after tax? 10 crore multiplied by the payout ratio 40% and multiplied by 1.07 will be the growth rate given in the question. 0.1093 is the cost of equity that we have just calculated minus 0.07. So this will be the market value. $108.91. 7% or 6%, let me just check. 7%. Okay, so this will be your pre-synergy market value using XYZ's dividend payout ratio. If we use the proxy's dividend payout ratio, it will be 10 into 50% into 1.07 divided by 0.1093 minus 0.07. That comes to 136.13. Okay. How to calculate the post synergy value? You just have to increase it by 10%. 108.91 into 10%. Okay, sorry, 1.1. 119.801 or 80 and 136.13 into 1.1. That's 149.74. So we have the four values here, 1, 2, 3 and 4 according to the dividend payout ratio. So first of all, see why there are 8 values. 2 into 3, range will have 2 values only. 2 into 3, like 2 cube of 2. First of all, we have pre and post synergy. Then we are using XYZ and proxies data. Then we are using two different methods, PE ratio and Gordon's growth model. Okay, so if you combine all of them, the answer, there will be in total 8 answers. 2 to the power 3, 8. Okay, let's come to the answer and finalize it. 120, 100, 32, 110. See, 120, 100, 132, 110. Then 136, 108, 149, 119. 136, 108, 149 and 119. Now you can just simply take the highest and the lowest value, because range includes the highest and the lowest values. So in a range for pre-synergy, if you look at the pre-synergy, there are only few answers. What is the lowest answer in the pre-synergy? This 100 is the lowest in pre-synergy. 100, 120, 108 and 136. 100 is the lowest. So what is the highest? 136 is the highest in the pre-synergy. Now, what is the lowest and highest in the post-synergy? The lowest is 110 and the highest is 149.74. I think 100 pre-synergy is 136. Yeah, so see these values: 100 and 136, 110 and 149. 100 and 136, 110 and 149. What they have taken is the lowest in pre-synergy and highest in pre-synergy, plus lowest in post-synergy, highest in post-synergy. That's it. All the other values that we have left come in between the lowest and the highest range. So this becomes the range of KLM. See, you can argue on the answer, sir. How will we get to know that we have to use the proxy entities also data and the XYZ's data? Absolutely correct. You can use any one data like XYZ's data and finalize the answer, proxy's data and finalize the answer. That's totally correct. But there will be at least 4 answers. Okay, sir, this was question number 59. I hope you understood that. Question number 60 is another and the last question on the geared and ungeared beta. 61 is similar to that. We are going to take it as homework. Now, I think 61, 61 will be given as homework, and 60, 62 and 63 will be taken by us. So let's have a look. Interesting question. Equity of KGF Limited is 410 crore. Debt is 170 crore. So let's start. Equity 410, debt is 170. The total is 580 crore, right? Printer division segment value is attributable to 74%. Printer division segment's value is attributable to 74%, okay, which has an asset beta of 1.45. Balance value is applied on spares and consumable division, which has an asset beta of 1.20. Now, this entire company has 2 divisions. Try to understand. This is printer division, this is spares and consumable division. This constitutes 74% of the total value, and this constitutes 26% of the total value. The asset beta, not the geared one, the ungeared beta of both is given, which is 1.45 and 1.20. This is of the company KGF Limited. Okay. Apart from that, the debt beta of the company KGFL, debt beta is 0.24. So debt beta is not given on a division basis. It is for the entire company. Okay. Debt beta is equal to 0.24. Asset beta of entire company is not known to us. Why? Because the asset beta that has been given is in 2 different parts. What we can do is we can calculate the portfolio asset beta, weighted average asset beta, by calculating weighted average asset beta by multiplying the asset beta of both the division with the values. So 1.45, see, 1.45 into 74% will give you 1.073. 1.20 into 26% will give you 0.003. 1.20 into 26%, 0.312. That's what I said. How is this possible? 0.312. So 1.073 plus 0.312 will give us 1.385. This becomes the asset beta of the entire company. Do you get that? Let me show you. This is KGFL. Beta asset is given in two different format, 1.45 also and 1.20, and the debt beta is given as 0.24. We can calculate the equity beta. So in order to calculate the equity beta, we have to first calculate the asset beta. Asset beta is equal to weighted average of the debt and equity beta. How to calculate? If you remember the geared and ungeared formula, asset beta is equal to weight of equity multiplied by beta of equity plus weight of debt multiplied by beta of debt. What used to happen was, we used to assume this debt beta as 0, and that's why the geared ungeared part was like this much only. But now it is like this. So what is the weight of equity and weight of debt? We can calculate that using this. We have the total 580. 410 by 580 will be the weight of equity. 410 by 580 will be the weight of equity. We have to calculate the equity beta plus 170 of the debt by 580 is the weight of debt, and now the beta of debt is 0.24. Beta of asset has already been calculated by us as the weighted average of the printer division and spares and consumable, that's 1.385. Now try to understand, this is what the total is. This asset beta is the weighted average of both. Okay. 0.70, 170 into 0.24 divided by 580, 1.385 is equal to 0.0703, 0.7069 equity beta. So if we solve this equation, equity beta will be 1.86. The very first question that it is asking is calculate the equity beta. Equity beta can be calculated as 1.86 like this. Beta of the asset is the weighted average of equity and debt. So we need 3. In order to calculate the equity beta, we need beta of the asset. Beta of the debt is already given. Beta of the asset is calculated from the weighted average. So let's have a look on the answer first. So this is the beta of the asset, weighted average 1.385. Then you will keep it here. Look at the formula. Beta of the asset is equal to beta of equity into equity by debt equity, the total of the capital, then beta of the debt into debt by equity plus debt. That's it. So accordingly, beta of the equity comes to 1.86. Cool. Okay. The second part is quite interesting. Ascertain the equity beta if KGF Limited decides to change its debt equity position by raising further debt. We are buying more debt. We already have 170 crore in our debt, in our capital. We are going to now raise further debt and buy back of equity to have its debt equity ratio at 1.90. See, we are going to buy back some equity and raise the debt. So what will happen? The total will remain same, 580. Okay, so I think let's do it like this. Total capital is 580. Debt equity ratio. What is the debt equity ratio required? The debt equity ratio has to be 1.9. So it should be 1.9 is to 1. Okay. How much is the total then? 1.9 plus 1. 2.9 rupees is the total capital, and out of 2.9, the debt ratio will be 1.9 by 2.9. So have a look. Debt ratio will be 1.9 divided by 1.9 plus 1. So this is debt, this is debt, this is equity. This is equity. So out of every 2.90 of the capital, 1.90 should be the debt. So how much the total debt can be? 1.9 divided by 2.9, or we can say, I will keep it here, and total or maximum debt that we can keep is, out of 580 will be divided by 2.9. This is the total, multiplied by 1.9. So this will be 580 by 2.9 into 1.90, that's 380. Total debt that we can have maximum is 380. Now first of all, deduct the existing debt. We already have 170 in our capital. Okay, 170. So additional debt to be raised. Additional we can raised this much. 380 minus 170, that's 210. That's it. In total, we will have the debt of 380 in terms of existing, 170, additional 210. Now, equity balance after buyback will be, total capital is 580 minus 380 is the debt. So 200 will be the equity capital now. So we have the three different types of capital structure. I will just write it down here. Equity, debt old, debt new. 200, 170 and 210. This is the procedure. 580. Now understand what this is the amount. Now let's calculate the weight of each. 200 divided by 580 comes to 0.3448. 170 by 580 is 0.2931. Then 210 divided by 580 is 0.3621. This is the weight of each of the capital in the company. We have to calculate the equity beta. We have to calculate the equity beta. This figure, let's say this figure is X, or we can straight away keep it as beta of equity. So this is the beta of equity. What is the beta of old debt and new debt? Old debt is 0.24, right? And listen to this. Assume that the present beta debt is 0.35. Now they have changed this beta from 0.24 to 0.35. So let's change it. It is now 0.35, and the additional debt that we are going to raise will have a beta of 0.40. So it will be 0.40. That's it. So can we calculate the asset beta is equal to equity beta into weight of equity plus beta of the debt old multiplied by weight of the debt old plus beta of the debt new multiplied by weight of the debt new. It's the same thing. It's the same formula, sir. The concept will not change. This is new. So write down. Asset beta is 1.3875, right? Let's find out from the previous answer. 1.385. Asset beta is 1.385. We have to calculate the equity beta. The weight of equity is 0.3448 plus, what is the debt beta? Old beta is 0.35. Old weight is 0.2931 plus new debt beta is 0.40. New debt weight is 0.3621. Let's find out the answer. 1.385, 0.3448 equity beta plus 0.1026, 0.1448. So equity beta will be, all the two figures will go on the other side and will get deducted from 1.385 minus 0.1026 minus 0.1448 divided by 0.344. So the answer comes to 3.299. Let me just check once again. 1.385 minus 0.1026 minus 0.1448 divided by 1.3448. 3.299. That is 3.3. Equity beta has increased. Earlier it was, try to understand, 1.86. Now it has increased to 3.299 or 3.3. Why the beta has increased? Because the debt has increased in the company. Higher the debt amount in the company, higher will be the risk. The more you add the debt, 3.296, it is 299 or 296. If you take it in 4 digits, it will be 3.299. Okay, so higher the amount of debt in the company, higher will be the beta value of equity. That means higher will be the risk on the equity. The third question says that whether the new equity beta, that means increased equity beta, justifies the increase in the value of equity. Beta, we can say, on account of leverage. Yes sir, it justifies the increase because higher capital, higher debt in the company increases the risk of the equity shareholder. It's very simple. The answer given by the institute will be confusing to you. I will just write down the other format of this answer, like other way we can answer this. I will just write it here. Yes, it justifies the increase in beta value as higher debt in the company increases the risk, which is also called as beta of equity. That's it. The more you bring debt capital into the company, the less are the chances that you will get anything on the liquidation. If you remember, I told you about this while explaining the geared and ungeared beta, that if we have debt in the company of 2 crore and at the time of liquidation we have only 2 crore, this entire 2 crore will be given to the debt holders because they are also of 2 crore, and equity shareholders will not get anything. So higher amount of debt in the company, lesser will be the chances, lower will be the chances that equity shareholder will get anything at the time of liquidation. Question number 61 is your homework. It is exactly same. We have to calculate the equity beta twice.